Hey, good afternoon. It's Chris Robinson, Robinson Ag Marketing with today's post-close grain and livestock comments. I got to start off with soybeans. Lower on the day, but I'm really more concerned about the last three trading days of actions. Um, Between Friday and Monday night's low, we dropped 38 cents. From Monday night's low and today's high, we rallied um, 55 cents. So that's a 93-cent swing in 3 days. Just think about that. If you don't want to do any hedges, bulls, bears, whatever your deal is, 93-cent swing in 3 days. I can't remember the last time we had some action like that. So definitely something to try and take advantage of. If you're following along with my program, robinsonagmarketing.com, I sent out a recommendation today to take a look at getting some 2026 beans hedged. 2026 beans hit 1131 and a half. There's a gap on the chart, which I put in the recommendation that comes in at around 11:33 and gets filled at 11:47. I sure do hope we go get it, but I'm not going to be left holding the bag in case something changes tomorrow and we start collapsing or start pulling back. Again, we've had a 93-cent swing in 3 days, 55 cents off the lows. I just think that it's unsustainable. So we've come so far so fast. You've got a lot of people who've never traded soybeans in their life suddenly excited about soybeans. That to me is just warning flag after warning flag. So I'm not saying we can't go higher. I'm not doing that. Don't text me and say, "Oh, you're calling a top." Nope. I'm saying this is a great area to hedge. And again, if you were kicking holes in the wall on Friday or even on Monday night when we opened up and Monday morning when we opened up sharply lower, if you were furious then, and now you've had this 55-cent clawback basically on headline news, right? So China bought um, um, some. We had some confirmations of China's buying beans. If you add up what they've bought all year long, it's about 1.5 to 2 million metric tons. That's what all the experts are saying. Um, that may sound like a lot if you live in New York City and don't know much about soybeans, but on a grand scheme of things, it's not that much. And also, you have to wonder, will they continue to buy long term if our beans are markedly more expensive than the beans coming out of South America? I mean, a memorandum of understanding is one thing. Write a check for something that you can get a lot cheaper in South America is another. So we'll see what happens. I think this is an opportunity. I don't think this is going to go away. I think we're going to have a lot more volatility this year. And this is typical what happens in markets. We had a flat year, right? A dollar trading range, put everybody to sleep. Everybody was getting mad and angry. We could be entering a period of 6 months to a year where we have moves like this all the time. And boy, if you're not using options to hedge, if you're using futures to hedge, you're going to get your clock clean sooner or later. I don't care if you're even if your timing's right. I mean, if you were bullish going into that report and then the soybeans dropped 40 cents on you, right? It's hard to hold that position and say, "Oh, I know. I had a dream last night. We're going to rally back, and 2 days from now, we're going to be 93 cents higher." That's nonsense. So volatility like this in demands that you do risk management, demands that you manage your risk, and just can't say that enough. So I think it's a hedging opportunity, selling opportunity. Net change on the day: D's corn up 2 cents at 436 and 3/4. If you're following my program, back a while ago we did use 439 to make a cash sale. After that report last Friday, it looked like it was a really good cash sale because we dipped below 430. We looks like we might want to take one more run up there and try and see what's above 442, 443. If you're following my program, I've got sales up there recommending. So if you want those, give me a call directly, email me directly. It's exactly what I do. I do make specific cash sale recommendations, and I do make specific hedging recommendations. If you're going to sell into this rally and you're like, "Oh my God, I can't sell into this rally because I think it might go another $1.50 in a month, like soybeans did," or you think corn's got another 30 cents to go. Hey, make the cash sale and re-own it on paper, right? Don't risk the whole rally trying to get the last 15 or 20 cents. So East corn up 2 cents, 436 and 3/4. Jam beans finished the day down 3 3/4 at 11.53. Traded as high as 11.69 and a half. We settled at 11.53 and a half. So 16 off the high. The low last night, 47 3/4. You do the math, another 20-cent trading range in soybeans. Get used to it. December wheat, a 9-cent trading range, finished up 2 1/4 cent. Again, kind of chasing corn there as well. Again, I think that's a selling opportunity for anybody that's got um, wheat in the bin. Certainly, you want to use the bounce that we've had off of the contract low to get yourself a better paper floor. A hedge is a paper sale, a substitute sale. Here's the expression. I didn't coin it by any means necessary, but the expression is get your risk on paper. You've got all your risk in the cash market, right? If you don't have your risk on paper, I think you're making a mistake. It's available to you. You don't have to spend a whole lot of money, and you can defend that price. It's price protection. It's price insurance. I know everybody hates insurance. Everybody hates insurance until their barn burns down, and the Allstate guy comes up with a check and says, "Here you go, rebuild." So that's why we hedge, because we never know what's right around the corner. Moving on to the livestock. Interesting. We did finish today red across the whole board. The most pressure was in the lean hogs, down $1.40, traded as low as 77.40, settled at 78 and change. If you look at Feb, that is a new low for the move. We tried to make a little bit of a stand there at the 80-cent level. That failed. We tried to hold at 79. Now we're sitting out right here at 78. It sure looks like it's very, very possible to go down and take a look at what's below 76, 75. We were all looking at this old low from April at 77.20. We went down today right to it, 77.40. I would continue to watch that. When markets start looking for floors, they start looking for old lows, and the computers will run to it, and then they basically do what everybody else does. They test it out. Is it going to hold? Is it not going to hold? But again, this is coming off what had been a tremendous rally. You go back to September 26th, almost 2 months ago, and we were trading at 92 cents. And here we are sitting here at 78. So if you're working with me, at least you had an opportunity to have hedges, keep hedges on. We'll be looking to roll those down, take money off the table when and where we can. Moving on to the feeder cattle, kind of a quiet day. I mean, when was the last time I said a five or a $4.50, $5 trading range in feeder cattle was quiet? But that's what we had today. We did finish the day down on the day in Jan feeders at 326 and change. March feeders, just inside a $4 trading range, hit 320. We opened at 318, traded the 316, hit 320. We finished the day at 318.4, down just a hair on the day, down 0.15 cents. And just like everything else, if we don't get a headline news one way or the other, we kind of sit here straight in this little trading range, waiting to see what's going to happen next. These are still great prices worth defending. If you look at fed fat cattle is at 220. People say, well, why would I care about 220? Well, because September of 2024, and here it is November of 2025. So let's go back to November of 2025. A year ago, we were down at $1.80. So you were going to sit here and tell me that 220 is not worth hedging just because it's not the high, which was 250. So there's still a lot of meat on the bone. I put that in my letter on the weekend. Defend the meat that's on the bone, and stop trying to get every last high tick. We're trying to really do a better job of hedging the value of these animals without hanging ourselves up by trying to pick tops. Right? We want to have a floor, keep it, and hopefully this cash market turns around. But if not, there's still a lot of revenue worth protecting. If you look at March feeder cattle, take a look at that, that math problem, right? We did claw back a little bit today, but again, we've kind of been sitting here at this level. If you take the break that we had in March feeder cattle from 378 to the low 3 trading sessions ago at 302 and change, 302 half. What's so interesting about 320.56? Well, it's the 25% retracement of that slam, that 76-cent slam from 78 to 2. So very, very technical. The next level we're watching, again, if you want these levels, just sign up for my letter. I do it every day. This is the homework that I learned how to do. I spent 18 years on the floor of the Board of Trade. I did a lot of this homework back when most people didn't even bother to do it. And it's not flawless. It's not perfect. It's not the key to riches. It's not the Midas touch. It's not the goose that laid the golden egg. But they can really, really help you make better decisions, especially when you're not sure what to do. If you have risk, these levels attract a lot of business, these retracement levels. And that's kind of what we've been dealing with here in the protein complex on these corrections, right? So I'm just going to wrap it up with that. If you're looking for help, give me a call, 312-638-8868. Um, there's not much time now between the end of the year and that January report. If I'm a farmer or producer and I just was gifted um, 55 cents, in the last 3 days after a terrible, terrible USDA report, if I was just gifted 18-month highs in beans for whatever reason, I don't care what the reason is. I don't care who was right, who was wrong. This is an opportunity you don't want to let go, because I can tell you, I don't know where we're going to be after that January report. But if we're not a lot higher, there's going to be a lot of angry people out there. And again, we hedge because we don't know. We hedge because we don't have a crystal ball. Um, I learned that a long, long time ago. You can have the fundamentals right. You can have the yields right. You can have what the government's going to say right and still have your face ripped off if you don't have a hedge. All right, guys, have a great rest of the day. This is Chris Robinson. Take care.